If I can ask Siva and then Prashant to come in on the other part of the confidence survey, which was on the fixed income space. The bottom line message that we seem to be getting from there was duration no longer a hot idea and accrual is the only game in town. Would you share that assessment of the respondents of the survey?
Yeah, absolutely. I think in this there is absolutely no confusion in my mind that the long story is pretty much come to an end, especially if you are taking a 3-year view. Remember, your 3-year view is 2017 to 2020. There's nothing which says that for the next 3 years you're going to get rate cuts. We've had, all the rate cuts are behind us. You may get 1 or 2, but you're not going to get enough rate cuts to make meaningful money. I mean, what are we talking about? The last 3 years we saw 10-year GSEC come down from that 8.5%, 9% down to 6.5%. So we made tremendous money. To make similar kind of capital gains, this 6.5 needs to go to what, 4%? It's not going to happen. And even if it were to go to 4 or 5%, whatever, it's not going to sustain there for 3 years. So the long story is certainly not a game to play for the next 3 years.
Right.
Maybe there's a trading opportunity in the near term, given that RBI has kind of sort of indicated they might ease. The market may be happy for the next couple of months, but genuinely, I'm not seeing a long story. At the short end, though, the story is very different. I don't like to use the word accrual fund because I don't believe that it's a 3-year.
So should we say credit funds?
Well, a credit fund, yes.
Okay.
So credit fund is fine. At the end of the day, if a credit fund runs 3-year duration, it's running 3-year duration. There's nothing accrual about it. A credit fund, I think there's interesting opportunities for 2 reasons. One is there is an improvement in the overall credit quality across the corporate sector. By this I mean improvement in profitability, improvement in, for example, over the last, in calendar year 2016, there were more than 2x the number of rating upgrades compared to rating downgrades. Right? Now, this is not very well known because we observe, or we see in the newspapers all the downgrade stories.
Correct. Right? Especially the high profile ones.
Right. So, and they are high profile. If you see the number of rating upgrades, they are significantly more than downgrades. But if you see the value or the quantum of debt being upgraded, it's still way below the quantum being downgraded. So what's happening is fewer, larger, more stressed, more leveraged companies getting downgraded and more smaller, less debt companies getting upgraded. Now, as a fund manager, this is great news because I don't have to buy these heavily indebted companies. I have a much wider range now to play with. And there you see this improvement happening on the ground. The second thing which makes me positive is spreads are a lot better than it were than a couple of years ago. At the bottom of the spread cycle, so your AAA, AA spread had fallen to something like 25 basis points. Now it is above 75 basis points. Right. So on the one hand, you see profitability getting better, rating upgrades happening in the system. And on the other hand, you see pricing in your favor. So I think it's a great strategy. I think the right thing to do is to perhaps go into AA credits, for example. I am still not bullish to go down the curve. We don't have evidence to suggest that, let's say, significantly lower rated. You're talking about the BBBs and so on are going to be a great opportunity. You mentioned this recent Amphi Summit where the SEBI chairman raised some of these concerns.
On that, yeah.
There was a presentation by CRISIL which said that if you look at the 5-year rating defaults history for AAA is like 0. For AA it's 0.75. You go to single A and BBB, those numbers are like 5-6%. That's the probability of default over a 5-year period. So I would say that if a probability of default is 0.75 and you're able to go into AA with a spread of greater than 0.75, it conceptually makes sense as long as you have a reasonably diversified portfolio.
Sure.
If you're going to run a few heavy positions, then you're taking a big risk. Correct. But if you're running a very diversified portfolio of AA's, I think it makes enormous sense right now.
Sure.
So I think that's the way we are approaching credit portfolios, and I think it makes tremendous sense at this point of time. Remember also that a AA bond today gives you 8.5 yield, and GSEC is at 6.5.
Correct.
You need to make significant capital gains on your GSEC portfolio only to catch up to a yield of a AA fund, and which is not given in the current environment. So I think all of this put together, it's a great environment.
Prashant, from your fund house point of view, would you agree with the assessment that duration, the best is behind us and now the only game in town is accrual?
I would agree with that view, and I think we have been communicating that as well. Only one point I want to highlight here is there is a tendency to disregard 7-8% kind of returns, which I don't think is the right view to way to look at it.
Sure.
When inflation was 9%, 10%, what we were getting was 10, 11%. It was hardly any real returns. In fact, real returns were negative. Today, when inflation is down to 4, 5%, real estate as an asset has not performed for 7, 8 years at all. So, which means even if you get 7% a year on fixed income, it is enhancing our purchasing power. So, I think there is a need to communicate that a 7% return actually means more today in the current environment.
In terms of
than
real
what-
return.
Yes.
Absolutely.
I think it is not just setting expectations right, but I think that's the correct view to take.
Sure, sure. Great.